Chair Powell's statement, "The time has come," was a standout moment in his speech at last week's Jackson Hole Symposium. After several false starts this year, Federal Reserve rate cuts now appear imminent, shifting the conversation to how quickly rates will decline. Historically, asset performance has varied based on the reasons for rate reductions. Risk assets tend to do well in soft landings and struggle during hard landings. In both cases, cash has consistently underperformed core fixed income, emphasizing the opportunity cost of staying on the sidelines, particularly in that asset class. The moment is ripe for investors to reassess their portfolios and ensure they're aligned with the upcoming rate-cutting cycle, especially given potential imbalances that may have formed in recent years. With PCE inflation now below 3%, confidence in the disinflation process has grown. However, softer July jobs data has heightened worries about labor market risks. The Fed seems focused on maintaining a soft landing by cutting rates proactively rather than reactively. A rate cut at the September 18 FOMC meeting now appears highly likely. If the labor market normalizes rather than collapses, these cuts may be seen as a normalization of rates rather than easing. Investors should note that current short-term rates may be at their peak. 3-month Treasury yields are likely to fall from 5.4% today to around 3.5% over the next 18 months. A key risk for investors in this environment is reinvestment risk. Fortunately, in fixed income, attractive yields are still available, with core bond yields at 4.4%, though this window is closing quickly. So, where should investors deploy capital? Risk assets such as large-cap equities and high-yield bonds have historically done well during rate-cutting periods that coincide with a soft landing. Notably, large-cap stocks have significantly outperformed small caps, suggesting a focus on quality is advisable. U.S. growth and value equity returns have been similar, indicating it's a good time to rebalance portfolios. When rate cuts coincide with recessions, risk assets have struggled. International equities have been hit hardest, followed by value stocks and small caps, while U.S. large caps and growth stocks have fared better. In fixed income, high-quality bonds have stood out, with high-yield bonds delivering negative returns while core bonds have posted strong gains, providing portfolio diversification. Understanding the differences between soft and hard landings is crucial for assessing risk and duration exposure. Now is the time for investors to take advantage of these attractive entry points while they remain available.